Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, April 25th here. Uh, you know, kind of a quiet day today. We have no economic items on the calendar today, so we're going to play it over to the headline news. Stock market is down again. Now, even though we got Q1 earnings reports for this year, and a lot of the reports are coming out pretty good. For the most part, they're hitting expectations. A lot of times, even exceeding expectations. We really haven't had anyone that's coming in low, but because the market has such really high expectations, if you're not overdoing what your forecasts are, most of the time your stock prices are going to go down. But the big items that are really kind of taking over the market this week, and today's no exception, is the 10-year Treasury. The yields on the 10-year Treasury have hit the 3% mark this morning. It's up. We'll show you in a little bit here over the 3% market. We haven't been at this level since in 4 years, and kind of what this is reminding the investors is that they're concerned because these yields, when they go up, that means borrowing costs for corporations that use it for their day-to-day businesses go up. So if their costs go up, that could slow things down on the other side of things with the corporation's economy and everything else. So they also take a look at, well, I'm getting a higher rate of return on these treasuries than where the stock market is currently because we're at such a high risk level. Stock prices have jumped up so much that this is a much safer, and I'll take this rate of return here. They sometimes will position their funds over into the treasuries as well and take advantage of that where it's a much more safe environment and they're getting the rate of return that they're seeking. Whereas if they're in a stock price that may have maximized so far where they're at or their position, they may be a little concerned about potentially going down, and they'd rather keep with a good rate of return. Now, also something to keep in mind is that inflation is something that could affect this, and we may be seeing this maybe next week, as soon as next week. Now, what's going on with inflation is the PCE will be coming out next week, personal consumption expenditure. This is the Fed's favorite gauge for inflation. Last March in 2017, we had it dropped. Inflation month over month dropped 0.2%. Now, because these are on a rolling 12-month radius, that's going to drop off the books and it'll be the new month. Now, if we get something in a positive territory, that could easily make us hit the target of 2% for the Fed. The Fed's target of 2%. What does that mean? That means they could speed up their interest rate hikes and continue with that this year. So initially we talked about 3%. There was concern that, remember, they may, with inflation, with wage growth and everything else, that potentially it could go up to, 4 hikes this year. And of course that concerned them. Now we've also seen the 2-year and the 10-year coming to a possibility where they could have an inverted curve, a flat yield curve to an inverted curve. Just last November, we were at 0.7% difference. Now right now with the 10-year going up a little bit, we're up about 0.5%. But just as soon as a week ago, or a week or two ago, we were down as little as 0.41%. So as the Fed raised rates, that's closing the gap. That's pushing that 2-year up further and closing the gap on the 10-year. And when we get a flat yield curve, it basically means your short and long-term rates are about the same. They're at a higher level. And we could potentially go to what they call an inverted curve, where the short-term rates are higher than the long-term rates. And that usually precedes a recession. So that kind of means that we could be forced into a recessionary period. This is why you're kind of seeing the stock market reacting the way it is, as well as the bond market. So and as we've talked about, there hasn't been a whole lot of buyers in the bond market, primarily because, one, the Fed is trying to reduce their balance sheet of the treasuries and bonds. The dollar's pretty weak, so if somebody comes in here, even though we have pretty high yields compared to the global level, they lose a lot of that value, end up losing money in the cost of the dollar with the exchange rates. So that's why we don't have a whole lot purchases in that level there. So let's take a look here. We are now hitting that second level floor of support we have here. We're at what they call the 100% Fibonacci level here. And since we've been going up. So currently we're down about 5 basis points, but earlier this morning we're down as much as 25 basis points. On the East Coast, a lot of the lenders probably came in with worse pricing. Now that we're here on the West Coast, the East Coast may have a change in their pricing if this continues. If it looks like it's going to hold, they may change their pricing. West Coast, we're just getting our price out now. It may be pretty similar to what we saw at the close of day yesterday, which closed down 14 basis points. So here's the yields, and now yields are reaching, as you see, 3%. We're up about 3.02. This is at 3.04, and we're up as high as 3.03 at one point, and kind of pulled back a little bit. Now, this is an important ceiling here, that if we break above this has been going on, it's a 30-year curve here, and it's been a pretty strong one, but it could break out at some point. Now, initially, it might kind of hold and then pull back a little bit, get a slight reprieve, and then come make another run for it later on. But in the meantime, some procrastinators, or not procrastinators, but other professionals out there think this will hold at least initially, and then we may get a pullback, and then we'll probably try another run, which it may break through the next time around. But be cautious. So if you're at this level, just be, if you got rates out there flying, if you got stuff out there, just be very cautious. You might want to float a little bit, see if we get a little bit of improvement. If not, you may want to just take the safety and go ahead and lock in. But you could float a little bit, and then if it looks like it's worsened, then go ahead and lock in. But again, we may get a little bit of improvement with if this definitely holds here or not. All right, so that pretty much wraps up the day here. Again, kind of a quiet day, but I just want to kind of go over the explanation of the yields today. Hopefully that makes sense for you guys. I hope you guys have a great rest of your day. If you guys want to get more data, just come over to Twitter. You'll find me at Twitter at Mike Bjork. Today we did talk a little bit about the mortgage application activity level, so I did put that stuff out there on Twitter. But again, you guys have a great day. Look forward to see you guys tomorrow. Thanks for watching. Bye-bye.